The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The cautious optimism on Wall Street to start the year. It gets T-boned at the intersection of policies coming from 1600 Pennsylvania Avenue. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Katie Greifeld. Kicking you off to the closing bell here in the U.S. You take a look at the S&P 500. We did hit that record high, the second one of 2026 yesterday. A slightly different story today, but you can see that big tech is still powering ahead. The Nasdaq 100 higher by about 0.3% at the moment as a rally builds in the bond market. You take a look at 10-year Treasury yields down about 4 basis points. Well, again, when it comes to that 10-year yield, we did get that softer than expected ADP print this morning, maybe giving a boost to the bond bulls. I also wanted to highlight Bitcoin, not necessarily the story of the day, but we are getting closer and closer to 90,000, currently sitting at 91, down about 2.3% at the moment.
Yeah, and it's kind of interesting because we started the day with a bit more of a risk appetite out there. Stocks actually were hovering around record highs at the open as investors did parse that mixed economic data on the labor market and the services industries. But while everybody was doing those calculations about the fundamentals of economic conditions and the impact on public equities, we got a harsh reminder that it is still Washington rather than Wall Street that's wagging the dog. First, it was a rally in shares of oil refiners like Valero, Marathon, and Phillips. This after President Trump said Venezuela would turn over millions of barrels of oil to the U.S. Then you had the reported seizure of 2 ghost tankers also moving commodities markets. Later in the day, a social media post by the president that sent defense stocks reeling with the threat of a ban on dividends or stock buybacks for military contractors until problems are rectified around what he calls the production of equipment. And then, of course, in between all that was an announcement by Trump that has now become the story of the day. The threat of an executive order, possible regulatory pressure, and investigations into the activities of institutional investors buying up portfolios of single-family homes across the country. It's been an investment strategy that some have said has contributed to elevated housing prices. PE firm Blackstone posting its biggest intraday drop since April. Rental home giants, Invitation Homes, American Homes for Rent, having their worst intraday drops since 2020. Even building material stocks like Louisiana Pacific and Martin Marietta have been drifting lower. We don't have a lot of details right now, Katie, on exactly how Trump would go about this, but it does really strike a nerve here into a long-standing economic and political issue that could become an even bigger issue during this current election year cycle.
Absolutely. Well, that is where we start the show. And joining us to discuss, I'm pleased to say, we have Meredith Whitney. She is CEO and founder of Meredith Whitney Advisory Group. Meredith, great to have you back with us. We've discussed on this show with you before that housing affordability, that is going to be one of the big topics in the 2026 midterm elections. And with that in mind, would love to hear your reaction to this post by President Donald Trump looking at maybe banning those institutional investors from buying single-family homes.
Well, I think what everyone has to remember is that this isn't the first idea that the White House has floated. Originally, they floated the 50-year mortgage or turning federal land over to new affordable housing development space. So this, I think, is one of those trial balloons they're floating. This one, interestingly, though, hits the jugular of Blackstone, as you said. However, everyone also has to remember that one of Trump's bigger donors and advisors is Steve Schwarzman, one of the co-founders of Blackstone. So I think when whoever put this tweet out, whether it was the president or someone doing it for the president, he quickly got a message, Mr. President, Steve Schwarzman's holding on line 1. So I think that this may be the shortest floated trial balloon of the White House's trial balloon to try to rectify affordable housing. It is true, I think you're spot on, that affordable housing will be one of the, if not the central themes of the midterm elections. So the the Senate in July passed a bipartisan bill addressing affordable housing, and just before the holiday break, the House passed unanimously a bipartisan bill to address affordable housing. So that will go to reconciliation, but the White House wants to have its say too, and I think it's trying to find what say it will be.
Well, as Romaine said, there's a lot of questions here about how this would even be implemented if it moves beyond this trial balloon stage. But President Trump's stated ambition here is to basically make housing more affordable, make it possible for younger people to actually afford to buy homes here. And just hypothetically speaking, if this were to go through, you think about the stats that investors of all sizes accounted for 30% of single-family home purchases in the beginning of 2025, and that the larger institutional investors own about 2% of the nation's single-family rental housing stock. If institutional investors weren't able to buy single-family homes anymore, how far would that go to potentially addressing this affordability crisis?
Well, the institutional market, if you're going to say that the total investment market is comprised 80% of mom and pop and then 20% of these institutions. So you take the institutional group out and they're really buying, and you see the home builders weakness today too. They're buying a lot of, they're trying to buy homes in mass. So they're not buying individual existing homes on a one-off basis. That doesn't get, they're too big of scale for that to move the needle. They're buying excess inventory from the home builders. So the real problem in housing is not just rates, but also the fact that there's very little existing home inventory on the market. And so people are staying in their own homes longer, and that keeps inventory tight. And so people are aging in place, and that's not going to change. So what the House and Senate bill address is creating new homes, new building homes, and a lot of it is focused on manufactured housing, and that is a closer solution.
When we talk about the solutions, though, is there sort of a sense here that maybe there should be some potential cap on some of the appreciation in rent prices? Because even when you look at the percentage of homes owned by institutional investors, still relatively small, as you just pointed out here. But when you look at the actual price increases on rental properties owned in those institutional portfolios relative to those that aren't, there's a huge disparity there. And I am curious if a rental cap, if at all, would even be something that could be considered.
Well, I wouldn't address, I can't address the rental market so much, but I can address the home buying market, which was the lowest in terms of volume in over 25 years in 2025. And 26 isn't looking that much better. And that is the real bugaboo in terms of people being able to afford a new, like a first-time buyer being able to afford a home. Set aside the rental market, it's trying to get people to invest and be able to realize the American dream. And I just don't see that happening anytime soon first of all, anytime soon. That doesn't mean that there won't be a lot of chin wagging closer to the midterm elections, and there are things that they can do. There are obviously longer term solutions that will get us closer to a solution. But I think that I don't feel as if this tweet today goes far at all.
How much do you think this has actually contributed, meaning this investment practice has actually contributed to that increase in home prices? I know there's a correlation, but I feel like the causation is maybe a little bit less clear. And we've even seen some moderation in some of those increases in both home purchase prices as well as rental prices since the pandemic has sort of waned.
Raymond, you nailed it. I mean, it hasn't moved the needle that much. The fact is that there has not been much inventory on the market. So regardless of who's buying the properties, a very tight labor market has kept prices high. And even if you lower rates, unless prices come down dramatically, you still have the same affordability challenge for new buyers and existing buyers. It's just very expensive to get into a new home, be it a first-time buyer or a multiple-time buyer. And that's a product of the fact that home prices have gone up close to 50% since 2020.
And so, Meredith, I mean, in your view, as you mentioned, there's been a lot of trial balloons floated. This is the most recent one. You bring up 50-year mortgages as well. When you think about, where we stand, the core root of why we're having this affordability crisis, I mean, what, in your view, would actually solve some of these issues that we're talking about?
I think you have a number of things that can happen at the legislative level, but so much has to happen at the local level. And what the White House can really champion is working with states through working with governors to sort of press the local municipalities to fast track zoning advancements, making it easier to turn commercial lots into residential lots, and fast tracking tracking type of environmental approvals, fast tracking a number of approvals. That all has 70% of real estate happens, at least 70% of the real estate happens at the local level. And the governors are the closest to that can really make a move. And of course, the White House and Washington controls a lot of the purse that goes to the states. So there's actually a lot of flexibility that the White House has that they haven't tapped into yet in terms of the latest trial balloon.
All right, Meredith, always great to catch up with you. A story, of course, we'll have to check in with you frequently, I think, this year. Meredith Whitney, CEO and founder of the Meredith Whitney Advisory Group. A lot more coming up on the show, a lot coming out of Washington, including changes at the FDA. We're also going to talk about the state of the M&A and IPO pipeline. Ted Smith, co-founder of Union Square Advisors, joins us in just a bit. This is The Close on Bloomberg.
Well, we're keeping an eye on the S&P 500, dipping down into negative territory. Of course, that's after it hit a record yesterday. But our next guest is expecting the S&P to return 8 to 12% with a target of 7,500 this year. Joining us now, I'm pleased to say, is Kevin Nicholson. He is Global Fixed Income Co-CIO over at the RiverFront Investment Group. Kevin, it's great to see you.
Thanks for having me. It's good to see you as well. Happy New Year.
Happy New Year. So when we get a target, we have to talk about it. 7,500. For context, we're around 6,900 right now. What does the direction of travel look like to actually get there by the end of the year?
Well, you know, that was the one thing that we thought about. We figure it's not going to be a linear path. We're going to see lots of volatility, and so you're going to have to kind of buckle your seatbelts, we think, through the course of the year. And plus, this is a midterm election year, so, you know, there's typically volatility around midterm elections anyhow. And so we think that we'll get some early, and then we'll probably have some pullback somewhere in the middle there, and we'll bump along to get that 7,500.
Do you have any concerns with regards to broad market gains that maybe this year we won't necessarily have that sort of rock solid leadership from big tech in the way that we had in 2025 and 2024?
You know, we have not shied away from mega cap tech. We think that they have the opportunity to continue to grow their earnings. Oftentimes I've heard the comparison of, well, is this an AI bubble? Is this 1929 or is this 1999? Well, I would say it's neither, because in 1929, the crash was led by leverage. While these companies are, issuing some debt, they don't have a lot of leverage. 1999 was led by companies that did not have earnings, and you were basically buying multiple expansion. In these cases, the companies have a lot of earnings. They're creating a lot of free cash flow. So we think that this is more like the 1950s, 1960s, where you're having productivity increasing, and then you have a more even growth, so that the bull market can last for longer.
Interesting. So important context there. And you make the interesting point that you expect basically to earnings to match up to some of the hype, even after, the incredible stretches that we've seen over the past couple of years for these companies.
Yeah, that's exactly what we're betting on. We also think that financials are also the other place that, should benefit this year, because we're also starting to get that steepening of the yield curve.
Sorry, when you say financial, are you talking about traditional banks, or are you talking about kind of the newcomers?
More traditional banks.
Okay.
Yeah, because you're getting rates coming down, so they can borrow or pay less for the money, and then they can lend it at much higher rates, and so that's an opportunity for them.
So your general outlook is that we are going to see a material drop in rates this year?
Well, I think that the front end of the curve will come down a little bit, and only a little bit, because the Fed basically has pointed to that they are looking at a 3% neutral rate. So there's not much more that they're going to do there. But I think that we will see the long end of the curve start to steepen. Because if you go back from over the last 35 years, 2s to 30s have averaged about 154 basis points. So if we have a 3% Fed funds rate, you figure that, the 2-year may be about 25 basis points above that. So then you just extrapolate that out. You expect to have a 10-year somewhere in that 4.25 to 4.5, and then the 30-year, 4.5 to 4.75 or so. So that's kind of how we've looked at rates going forward.
4.5 to 4.75 on the 10-year. How do you think?
The 30-year.
On the 30-year.
Yeah.
Okay, that's important because
Yeah.
I was going to ask. I mean, how does the equity market digest some of those levels that you're talking about? If we're talking about the 30-year, maybe a less urgent question, but you're describing a bear steepening impulse. When you approach, the market from the perspective of investing in fixed income, where does that leave opportunity for you?
I don't see that there's a lot of opportunity in fixed income, ironically.
Really?
Because credit spreads have been tight, and the front end of the curve, I don't really think that it has a lot more room to go down. And so right now, until I see yields go back up, I see the 10-year push closer to 4.5. That's when, I want to be involved. But right now, we're short duration in our fixed income portion of our portfolio. And, because we're thinking that we're going to see that steepener happen.
All right, Kevin, always great to catch up with you.
Thanks for having me.
Kevin Nicholson, Global Fixed Income Co-CIO at the RiverFront Investment Group. And we should point out stocks now hitting session lows, at least on the major indices, including the S&P 500, now down about 0.1%. When we come back, we're going to focus in on the other big story of the week, and that's the flare-ups over Venezuela. Concerns that it could roil global oil and food prices and aggravate tensions between the U.S. and China. A conversation up ahead with Joseph Webster, Senior Fellow at the Atlantic Council's Global Energy Center. This is Bloomberg. All right, we continue to keep a focus on what's going on Wall Street, but this is one of those days where what's happening on Washington is what's driving the price action, Katie. We talk about that dip down that we've seen in stocks, a bit of softness here, and that's largely because people are trying to parse a wide variety of, I don't know if you call them policy proposals, or at this point, some of these are just social media posts. You have Scott Bessent tweeting about potential car loan interest relief. You have the President of the United States tweeting about affordable housing and maybe cracking down on Blackstone and some of these institutional investors that are buying up single-family homes. And I don't know if investors, do you take it seriously or do you wait until you actually see a formal policy or a formal legislation or regulation put out there?
Well, you take a look at the reaction specifically in Blackstone, other shares as well. It seems like investors are taking this seriously for the time being. Whether or not this is a dip that gets bought will certainly be interesting. But you think about Blackstone's exposure here. In 2021, they bought Home Partners of America. That was a $6 billion deal for them. That added 17,000 rentals to their holdings. They more recently bought Tricon Residential. That was a $3.5 billion transaction. That added 38,000 U.S. rental houses. So this is a huge area of exposure for them. Yeah,
and they're basically the largest landlord. But to that point, though, too, as we were preparing for the show, I was like, well, how much of a percentage of our housing market is basically under the thumb of institutional investors? It's pretty minuscule. I mean, depending on what number you want to look, it could be as low as 1% to 2%, but even the highest numbers were still under 10%. So it's still somewhat of a small sliver of the broader market. So to your question that you posed to Meredith, Whitney, how much would this even move the needle in terms of prices?
Versus how much of this is posturing ahead of the midterm elections, where we know affordability is going to be, if not the key topic, one of them.
All right, well, the other big story of the day, of course, involves Venezuela. We've been keeping a track of 2 ghost ships seized by the U.S. earlier today. Trump also saying that Venezuela has agreed to return about $2.8 billion worth of oil to the United States. But a lot of questions right now about what comes next after the removal of Nicolas Maduro over the weekend and the U.S. involvement in a South American nation. Joining us right now to talk a little bit more about this is Joseph Webster, Senior Fellow at the Atlantic Council's Global Energy Center, a non-resident Senior Fellow at its Indo-Pacific Security Initiative. And Joseph, I do want to start off on the issue of how what has transpired over the last few days going to potentially impact the actual price of oil.
Well, thanks for having me on. Great to express some personal opinions here. So you can see this reflected in the markets where WTI is down slightly since before the crisis, and you see some refineries like Valero are up in terms of stock price pretty significantly. So the market, at least for now, anticipates that WTI crude prices will decline somewhat from prior expectations. On the other hand, that's going to benefit some of the refineries such as Valero, which is a pure play refinery. So that's the initial reaction to the news from Saturday.
Phillips 66 also, you saw the reaction in their share price as well when it comes to the refineries. But this is a conversation we've been having all week, and that's whether or not you think about the American oil companies, the oil giants, whether or not they're going to have the desire to invest heavily in Venezuela, the capital needed to build back up some of their infrastructure when it comes to their oil industry. And Joseph, I wonder where you fall on that question.
Yeah, it's a great question, and one I think a lot of American oil executives are thinking about. So, there's been some great analysis on some of the technical matters. So you all had Amrita Sen on earlier this week to talk about how at least Energy Aspects expects that crude production could rise something like 500,000 barrels a day, but it'll take at least 2 years and probably require at least $10 billion of investment. So there's a lot of uncertainty on the Venezuelan domestic political side. And I don't want to get into the U.S. domestic political side too, but I would say there's a significant amount of uncertainty that U.S. executives have to grapple with before deciding whether or not to invest in Venezuela. So on the one hand, they have alternative measures, they have alternative places to invest, like the Bakken, like the Permian. But at the same time, there's a real question about sustainability of U.S. policy towards Venezuela. So will that continue? Will that continue past 2029, for instance?
I am curious, Joseph, as to whether there has been any real assessment right now of China, not just their political involvement in Venezuela, but more importantly, their economic and financial involvement. I mean, they are holding quite a bit of debt. And I am curious as to whether the U.S. will make good or find a way to make good on that to China, or whether China itself is going to have to find a way to make sure that Venezuela and the U.S. make good on it.
Yeah, it's a great question, and one where there's more questions than answers regarding China at the moment. So as you saw, according to some press releases last night, the Trump administration has requested Venezuela cease or sever all economic ties with China, with Cuba, with Russia, with Iran. And it's not clear to me what the severing of economic ties requires. China, as you mentioned, has traditionally had very significant economic presence and financial presence in Venezuela. There's some amount of debt that Venezuela still owes. The best estimates I've seen suggest that China still has $10 to $12 billion of debt that Venezuela owes it. But that's a real question going forward. What happens to the Chinese economic presence in Venezuela after this shakes out?
Certainly a big question. Unfortunately, Joseph, we have to leave it there. Great to get some time with you. That is Joseph Webster. He is Senior Fellow at the Atlantic Council's Global Energy Center and non-resident Senior Fellow at its Indo-Pacific Security Initiative. Now, coming up, 2025 was one of the best years ever for M&A activity. Up next, we'll discuss whether the momentum will carry through with Ted Smith, president and co-founder at Union Square Advisors. This is The Close.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're focusing on these markets. We're also focusing on M&A, and we're focusing, again, on Warner Brothers Discovery, rejecting that amended takeover offer from Paramount Skydance, encouraging its shareholders to stick with Netflix.
Yeah, and not a surprise. So I assume this is not the end of the story.
No.
I mean, David Ellison seems to be pretty intent on trying to get this through, but at least strictly from a financial perspective, it's pretty obvious which direction Warner Brothers is leaning towards.
And it was interesting reading from the company, their statement, Warner Brothers Discovery, that is calling out the extraordinary amount of debt financing as well as other terms of the Paramount offer that really have them concerns about whether or not they could actually close this deal if they even went with it.
Yeah, absolutely. And that was it's funny, that was actually last year's big story. And of course, that will be a big story in 2026. But we've already started off the year with a ton of news with regard to M&A here. Even today, we were just talking off camera about AbbVie, maybe buying RevMed, a deal potentially for Olaplex to be taken private, Blackstone, TPG, that Hologic deal finally looks like it's getting through the pipeline. So we're coming off of a really phenomenal 2025. And I guess at least if you're an M&A advisor or a lawyer, 2026 might be pretty good as well.
Absolutely. Yeah. Those deals also an early answer to the question of whether or not we're going to see that momentum continue. So let's keep the conversation going now with Ted Smith. He is president and co-founder over at Union Square Advisors. Ted, great to have you with us. So we know that 2025 gangbusters when it comes to M&A. It seems like a lot of that activity came in the latter half of the year. And interestingly, you point out in your notes that a lot of that came from larger ticket deals. It was the deals worth less than $1 billion that really declined last year.
That's true. And first of all, Romaine, Katie, thank you for having me on again. Happy New Year. We definitely saw sort of a separation from the large deals versus the medium and smaller deals last year. Overall, as you've already pointed out, it was a gangbuster year for M&A, really up almost 70% in tech, from about 450 billion to over 750 billion. But a lot of that did come from those larger deals. As we saw the bigger companies and PE firms wade in to participate in a number of those large transactions. And as you mentioned, Katie, a lot of those that were in the smaller end of the scale, $1 billion or less, really we saw a decline in that market by about 20%. We think overall volatility in the markets that we saw, we think the effect of tariffs, at least in the first half of the year, a lack of alignment on valuation, all those contributed to a decline in that part of the overall M&A segment. We think it's going to be better in 2026, but it was definitely kind of the haves and the have-nots for 2025.
And Ted, I'd love to talk about how those deals are getting done, so to speak. We were just talking about Warner Brothers Discovery seemingly uncomfortable with the debt financing as it relates to the Paramount Skydance bid. That might be a very unique situation here. But when it comes to how these deals are being paid for, what trends are you seeing when it comes to cash versus equity versus debt?
Yeah, we're certainly still seeing cash being king, as cliche as that is. We see that in most of the transactions around tech. Obviously, larger deals, whether it be Warner Brothers, Netflix, Skydance, obviously there has the potential for a significant amount of debt, as there is in at least one of those situations. Tech buyers tend to finance principally with cash off their balance sheet, except for the very largest of transactions. The same is generally true for private equity firms. As interest rates have gone up until 2025, when they started to come back down, the use of debt from most PE buyers has tapered off a bit. They'll still use debt, just not as much as they have in the past. So I still think this is all about strategics and sponsors spending cash that they have in their funds or on their balance sheets, potentially backfilling with debt after a transaction closes. We're still not seeing a terribly large amount of pure equity-driven, stock-driven transactions, although that could change given the overall strength in the underlying equity markets that we continue to see.
Given the regulatory environment, Ted, do you think that the more prudent exit option would be through the equity markets, the public equity markets, or with a private M&A transaction?
We still continue to believe, and obviously as M&A advisors, this is what we're trained to believe, that the M&A exit is going to be the better alternative. We think the IPO markets are open for a select few companies that remain of scale and that can truly get multi-billion-dollar valuations in the public markets. That was a fairly challenging path last year. It felt like those markets were opening up after we got through the first half of the year and the effects of tariffs. And then we ran into the government shutdown that put a number of companies on the sidelines in the fourth quarter that were hoping to get public. Obviously, it's really early in the new year now. We haven't seen many of those companies announce their intention to come back public just yet. But the reality of it is IPOs that we saw a number of companies come out and have very large day one pops only to lose significant amount of market value after the fact. And overall, tech IPOs that came out last year underperformed the S&P. So even though there were some notable bright spots and we still see companies that evaluate the IPO as a liquidity option, the vast majority of companies that we think are going to get liquidity for themselves and their investors are still going to do it through a sale to a strategic or a financial buyer. Yeah,
I was actually looking at some of the returns on some of those big names from last year. Definitely a mixed picture. But it gets to the idea too, Ted, about this idea of how companies want to grow right now and whether that can be done organically or whether they really still need to be involved in the M&A process in order to get that scale or continue to build that scale.
I think the larger companies are always going to be evaluating the need for M&A to enhance their slowing organic growth. We certainly see that in the technology sector and a number of the transactions that have been announced over the course of the last year. And I believe we're going to continue to see that. Cautious buyers, to be sure, but needful buyers. And we think the large strategics will continue to participate in that. And we also think that the investors in the companies to be acquired, particularly those private companies at least to be acquired, really have a need for liquidity on their own end, given the age of their funds, given the demand that their investors, the LPs in those funds, have for liquidity today. So we think that this year really is going to see a further opening up of the M&A markets because you've got as you point out, Romaine, the need for growth on the part of the strategic buyers, at least, and the need to sell on the part of the investors in the private companies that are involved in those transactions.
Well, Ted, you touched on something that I've been wondering about, which is, when we think about the deal making that we might see in 2026, how much of that is basically going to be a function of maybe some of these private equity investors have held on to their investments for too long and they need some sort of liquidity, some sort of exit opportunity at this point?
We think that's going to be a huge driver. That groundswell began in 2025, and we think it's going to continue and increase this year, depending on how you look at the statistics that are out there. Anywhere from 25 to 50% of current investments by private equity, venture, and growth equity players are out of funds that are 10 years old or older. And most of those vehicles are intended to be 10 to 15-year vehicles in and of themselves. So now you've got aging funds, aging investments, and a desperate need for the funds that have those investments to seek liquidity through traditional sell-side processes or an emerging class of solution around continuation vehicles, which we're also seeing a significant upswing in.
All right, Ted, always appreciate the insights here. Ted Smith, president and co-founder over at Union Square Advisors. And, Katie, I was just looking up on the Bloomberg terminal some of the returns of those IPOs that we had this year.
Yeah.
Because to Ted's point here, the top 20 IPOs last year in terms of offering size, 1, 2, 3, 4, 5. Only 6 of those names are actually in the green right now since their IPO date. So that gives you some sense here, kind of what he was talking about.
Tell me what function you're using on the Bloomberg terminal.
It's called IPO. Go,
Makes
Katie
a lot
Greifeld.
of sense.
Absolutely, yes. The magic box here on Bloomberg. When we come back, we're going to continue keeping a close eye on what's going on in the financial space and particularly what's going on with Blue Owl Capital. The drama continues. The stock under pressure once again after a big change to one of its private credit funds. We cover that in our Stock of the Hour. Up next on The Close. This is Bloomberg. Our Stock of the Hour, we're keeping an eye on Blue Owl Capital. The share is sliding after the company sharply boosted the amount investors can withdraw from one of its private credit funds. Now, the move follows a wave of redemption requests last month and aims at protecting Blue Owl's investors. This, according to co-founder Craig Packer. Joining us right now is Davide, Scigliuzzo, chief correspondent for private capital for us here at Bloomberg. All right, there's a lot to unpack here, Davide. This has been sort of an ongoing drama for the last few months now. Give me a sense at what we mean right now when we talk about allowing that 17% withdrawal. Does that put this to rest, or does this just raise more questions?
So from Blue Owl's side, that's definitely the hope, that they are basically saying, look, no matter how concerned you are, we are going to honor all of your redemptions, and we're bumping up the limit from 5 to 17 to make sure that we can meet all of them. And that's obviously an investor-friendly measure. They could have chosen to gate the fund instead. What remains a kind of an open question is whether that will be enough to kind of reassure investors broadly around private credit, because other funds have also been under pressure. This Blue Owl particular fund is a bit of an extreme case, but there definitely have been for months now concerns around the outlook for private credit as an asset class, particularly as rates continue to decline.
Yeah, absolutely. You think of BDCs, they had a pretty rough 2025. And you think about the broader context here, private credit, a lot of big asset managers, Blue Owl among them, have been trying to open up this asset class to retail investors. And you could make the case that this entire experience sort of highlights the risk of that.
Absolutely. And I think, it was very easy to sell private credit to retail investors when rates were going up. And you could make a pitch that, this asset class was delivering equity-like returns for much safer risk profile. But that is getting more difficult now. And there is an inherent tension in selling private credit to retail investors, which is private credit investments are illiquid. They're made for long-term, 5-7 years. That's not typically an amount of time that your average individual investor is going to be comfortable with locking their up money for. So you have to offer them some liquidity, and the difficult part is deciding how much. Most of these funds have decided that quarterly redemptions subject to a 5% cap is a good compromise. What that means is that investors can pull their money out every 3 months, but the manager has the option to gate those redemptions. And those gates are there to prevent forced selling of assets that are illiquid, and therefore, if you're forced to sell them, you may have to sell them at a very discounted price. That is still the question.
All right, Davide, really appreciate the context here. That is Davide Scigliuzzo. He is chief correspondent for private capital over at Bloomberg News. It's interesting, Romain, you take a look at how Blue Owl performed in 2025, the share price down nearly 36%, and certainly a lot of their peers felt that hurt as well.
Yeah, and there's been a lot of questions about the publicly traded vehicles and whether it actually is even a good idea, particularly with the low liquidity of nature of some of these investments. And of course, now all of the talk about maybe pushing some of this stuff through the wealth channel into some of our retirement portfolios. Definitely some structures people need to work out.
Absolutely. We'll keep an eye on that story, and we'll keep an eye on the closing bell. Up next, we'll take you there with Larry Adam. He is CIO over at Raymond James. This is The Close on Bloomberg.
We have not shied away from a mega cap tech. We think that they have the opportunity to continue to grow their earnings. Oftentimes I've heard the comparison of, well, is this an AI bubble? Is this 1929 or is this 1999? Well, I would say it's neither.
Kevin Nicholson kicking us off to the close from RiverFront Investment Group, still relatively bullish on tech stocks. And we should point out that's actually one of the few bright spots today here, seeing the Mag 7 holding in the green. And some of those big chip names like NVIDIA, which had been under pressure yesterday, getting their sea legs back here on this Wednesday afternoon.
But then you think about the other side. You do have Apple and Meta down. Those are some of your biggest weights on the S&P 500, which you can see is close to session lows. The NASDAQ 100 is holding on to those gains right now, but we have 9 whole minutes until the closing bells. A lot could change, Romain. Meanwhile, bonds rallying a little bit and Bitcoin falling out of bed. Yeah, 9 whole minutes. So you certainly could a lot could change, apparently, especially if the president decides to tweet something else out. We should point out only 4 of the S&P sectors are even in the green, and really only 2 of them had meaningful gains, and that's basically healthcare and then communication services, which of course is really being driven almost entirely by Alphabet. Yeah, absolutely.
All right, we are just about 8 minutes away from those closing bells. Larry Adam joins us here in Studio 2. He's the Chief Investment Officer at Raymond James, and he joins us here at the start of the year, I think a year where a lot of people are relatively optimistic about where public equity is to go, despite some of the issues that we're having today. Are you optimistic?
We are optimistic. I would probably say we're cautiously optimistic. Our target for the end of the year is 72.50.
Okay.
So from today's levels, it's around 4% if you're looking from a price appreciation, and then another 2% for dividends. So mid-single digits, which is a really big difference from where we've been the last couple of years, where we've been 6 out of the last 7 years, we've been up 15% or more. Yeah.
Well, there's been a lot of talk. I mean, we talk about 3 straight years of double-digit gains, and obviously a 4th straight year is, at least historically, a bit of an anomaly. But when I hear you say roughly a 4% increase from where we were, I see a lot of other estimates out there that are much more aggressive, 10% on the year, maybe even higher than that. Why are you a little bit more cautious?
So I don't disagree that the fundamentals are healthy, right? We're not going to have a recession. If you look at earnings growth, margins, and real sales revenue, they're all above historical averages. And the Fed cutting interest rates is a positive. Where I get a little bit more concerned is 2 things. Number one, valuations. We're in the 95th percentile when it comes to valuations over the last 20 years. And then positioning. You just mentioned it. Everybody's positive on Wall Street. If you look at retail investors, they have the largest allocation to equities that we've really ever seen. And then when you look at surveys, the highest number of people that think the market's going to go higher over the next 12 months, it's over 52%. It's pretty much a high. And historically, when you get everybody moving in that same direction, historically it makes the market vulnerable to at least a temporary type of pullback.
Yeah, I mean, you think about 2025, all of the money that was being funneled into ETFs in particular, which I spend a lot of time on, it was staggering. But I'd love to get specific and talk about some sectors here, because I'm taking a look at your notes. You position healthcare as sort of a contrarian sector bet that you're making. And you think about healthcare, talk about policy risk. I mean, that sector has just been whipsawed by Washington. So what do you see as the bull case for some of those health names?
Well, first of all, if you look at it from a sector perspective, it's underperformed 3 years in a row. If you look back, it's never done it 4 years in a row. When I look at valuations, because of those headlines that you're talking about, the rhetoric coming from Washington, it's still trading at a pretty significant discount. And then those headlines that you mentioned, most favorable nation pricing, 250% tariffs, they've all started to get walked back, right? And in fact, probably one of the biggest reasons why we continue to like it is that a bunch of those names in that sector actually have deals now with the president and the White House. But what happened to their earnings? They weren't revised lower, which means that most of the bad news was already priced into it. And then from an earnings perspective, I think they're going to continue to grow their earnings. And I think a lot of these, the valuations will unlock value in that particular sector.
Yeah, it's a great point on the earnings revisions that we haven't seen when it comes to some of those health names. But speaking about policy risk, let's talk about the defense industry. Another headline that we got from President Trump today saying that he won't allow defense companies to issue dividends or buy back their own stock unless they invest more in production and research. I know that defense contractors, that's an area that you like in this market. How are you weighing this sort of news?
Well, first of all, I like that particular sector because of the thematic theme, right? The fact is that around the world, we're going to continue to see increased spending when it comes to weapons and defense systems. So that's a primary reason. I think you're also going to see a lot of buildup in the whole power industry. So I like the sector and their earnings power going forward. When it comes specifically to dividends and buybacks, let's put it in perspective, right? When you look at the dividend yield of the aerospace and defense sector, 1.1%. So not a huge dividend. And when you look at buybacks, for that entire industry, they bought back less than 1% of their shares, one of the lower sectors in the S&P 500. So I wouldn't make this headline as big as people are making it. I think if there's a pullback, I'd look at it as a buying opportunity.
And it's interesting, too. I mean, we talk about the thematic nature of that, and we should just point out to our viewers, we actually have an interview later in the 4 p.m. hour with Palmer Luckey, the founder of Anduril. And there's been, of course, a lot of talk about sort of these newer defense companies. You know, I mean, it's one thing to invest in Lockheed or Boeing or General Dynamics, but you have kind of these new defense tech companies that have all sort of bubbled up that everyone's trying to get a piece of. A lot, not public just yet, but a lot of people trying to get a piece of that. Do you see that as a persistent thematic theme for investors going forward?
The whole defense sector?
Yeah.
I do, because you're seeing it. I mean, look at the big gap.
Yeah.
What, for example, NATO's paying at 2.5% and where they want to be, that's a huge gap and a significant amount of spending that's going to go forward. And by the way, it's not published exactly, but if you look at our military armaments, they're at pretty depressed levels. So we have to replenish a lot of the military arms that we've been using here over the last couple of years. So I'm still long-term bullish on that sector and a lot of the space that you're mentioning.
You know, despite all the gains that we had last year here in the United States, there's been a lot of talk made about some of the outperformance that we saw by non-U.S. markets. There are a lot of factors that led to that. And I am curious as to whether you think that outperformance could potentially continue. And if so, is there a case to be made for further allocation by U.S.-based investors to non-U.S. assets?
So I think that that's more of a flash in the pan.
Okay.
I still favor the U.S. over those other developed equity markets. And the reason for that is that when I look at, for example, policy mix, we have a lot more favorable policy mix. We have the one big beautiful bill, which is fiscal stimulus. And the Fed, from our vantage point, is going to cut one more time. You look at Europe, they're on hold. In Japan, they're either raising, and their interest rates are already at 30-year highs. When I look at the sectors that I like, you get more allocation to them here in the U.S. And then when I look at it from an earnings perspective, U.S. companies are going to have better earnings than what you see in Japan and in Europe, and that tends to lead to better price performance. And when you talk about that outperformance last year, that was primarily driven by weakness in the dollar. It wasn't because the companies did better. But if there is an area I would look, it'd be EM Asia. And one of the reasons for that is a lot of the exposure that you're seeing there from technology. If you go after the U.S., the next big place you see big tech companies is EM Asia.
All right, Larry. Well, we're going to have to check back in with you on that trade. We have to leave it there. Larry Adam, CIO over at Raymond James, helping us count you down to those closing bells. Just about 2.5 minutes away. The majority of stocks in the S&P are in the red, though you have some bright spots out of Alphabet, NVIDIA, Microsoft here on the day. But as you pointed out, Katie, Alphabet and Meta, a big drag on the broader indices, and a lot of questions about the defense and asset management sector. A full breakdown starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to that closing bell with the global simulcast. It starts now. Carol Massar, Tim Stenovic join us from the radio room. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube on an incredibly busy day for financial markets. I'm not sure where you want to start. Carol Massar, the president, has been on fire all day long, tweeting out a bunch of policy proposals, I guess if you can call them that, could affect a whole swath of industries. Take your pick.
No, exactly. And we've been talking to folks who are watching the market, and like whether it's a headline and then you got to wait to see the details of ultimately does this turn into some kind of policy from the White House. But yeah, the defense industry, the housing industry, some of the big investment firms, the private equity guys, we've definitely seen them react to news out of the White House.
Interestingly enough, it was enough to kind of change the overall tone of the trade this afternoon when the president did go on social media and make these proclamations, pronouncements,
proposals.
Perhaps? I
Perhaps?
do have questions about some of the enforceability
Social media posts
of some of these, but they're certainly moving markets and they move individual stocks too.
Yeah, absolutely. I mean, you take a look at Blackstone, there's a lot of questions about how exactly this ban might actually be implemented if it is more than a trial balloon. But you take a look at the shares, down 5.5%. Certainly someone is taking this seriously.
And we should just point out, too, just to be very clear, a couple of these proposals basically could only happen with the help of Congress. And as we know, Congress has had some serious issues with regards to getting anything done. Don't forget, there's still a budget battle that has to be resolved by the end of this month. And, of course, with the recent passing of a key member of the Republican caucus, you now have a much smaller majority to maybe potentially get things on. And we should also point out, we are getting a headline crossing the Bloomberg terminal right now that President Trump is scheduled to deliver his State of the Union speech on February 24th. So a lot's going to be going on over the next few weeks for investors to keep an eye on out of Washington that will have a direct impact on what happens on Wall Street. As for what happened today, the Dow Jones Industrial Average lost 466 points, or about 0.9%. The S&P lost 24 points, or 0.3%. The NASDAQ Composite managed to hold on to its gains for the day, but only just up about 0.2% here on the day. The NASDAQ 100 up about 0.1%. The Russell 2000 in the red, down 0.3%.
All right, back to the S&P 500 I go, and most names in that index lower in today's session, guys. 389 names losing ground in the S&P 500. Katie, 114 to the upside.
Yeah, breath was not too pretty when you take a look at this circle of sectors. In terms of what did well today, healthcare having a surprisingly good day, up about 1%. Communication services, too. Information technology, that's only higher by about 0.1%, but we know that that's a pretty big weighting. In terms of
Why is
the
it called
downside,
information technology?
I don't know. It feels very formal. I usually
very
just call it tech, but
Old school, right?
Services.
listen, the circle says information
Can someone
technology.
talk to S&P about this?
I'll try if they're watching. Anyway, I have to tell you about utilities, Romaine. It was down about 2.5% as a sector. Industrials, materials, also some of your biggest losers, Carol.
How do you get anything done over there, Katie?
Exactly.
You know,
and the award
it's a give and a take.
Yeah.
You know, they keep her sequestered on the other side of the building.
That's true.
Just so she gets work done.
I only see Romaine for 2 hours a day.
That's all the doctor ordered.
All right,
Carol.
well, you do it well. All right, let's get to some of the individual gainers. Hey, guys, you want to see something really cool? Go to NDX Index DES, SPX Index DES, and the 4 top gainers in both of those averages are exactly the same.
Cool.
Intel, Regeneron, CrowdStrike, and is it Palo Alto? I just think that's kind of wild.
All right, cool. None of those names are on the screen.
Okay. Intel is the #1 gainer in the S&P 500, the NASDAQ 100. It was up more than 11% at its intraday high today, finishing with a 6% gain. That intraday high, highest level since April of 2024. Bond trading volume jumped on this one. Options trading surged, led by those $46 calls. Keep in mind that Mobileye Global, of course, buying that humanoid robot maker Menti for $900 million. Mobileye's biggest shareholders is Intel, according to Mobileye. So I don't know. That was the only news I could find, but I just thought it was kind of interesting.
Okay, that's a stretch. By the way, did you see all the humanoid robots everybody's been parading out at CES?
They've moved very
They're
slowly.
very scary. No, did you see the Boston Dynamics one?
Yeah, that's one.
Like if I saw that walking down the street, I
know.
would cross.
That guy can. That robot can do cartwheels.
Is it still the little dog, or are we talking about a different?
No, this is
it's like your size.
person.
Oh, God.
You're probably
Keep
stronger.
it away from me. I doubt that.
All right, moving along, everybody. Anywhere Real Estate, ticker is HOUS. That was definitely a gainer in today's session, finishing the day with a gain of about 17.5%. Compass also higher. We'll bring that one up 9.5% to the upside. Anywhere Real Estate shares climbing to their highest level intraday since 2022 after announcing that its acquisition by Compass cleared regulators. So again, that deal getting done. So we saw both of those names to the upside. And then one more for you, LGI Homes. Oops, maybe we shouldn't bring it up.
But we did. There it is.
It was up almost 10% at its highs today, finishing with a decline of 1.6%.
This is
I love
why I
this.
don't.
For our viewers who don't know, our listeners, I should say, Carol, her job, her only job, is every day to come out and tell you which stocks rose. But very frequently, she sometimes has something on there
not
that
too
actually.
frequently. Not too frequently.
It's the first time it's happened.
This is why,
year.
just a note to our producers who give me a hard
Katie,
time about like
also
why I
not
don't
nice.
send the names that are down until like 3:58 p.m. It's because I just want to make sure they're still declining.
You know what? Not Happy New Year to you two anymore.
All right, let's move on because I've got a few decliners for you guys.
I have a decliner for you too, Tim.
Oh, you do. Let's talk, though, about defense names. Lockheed Martin, Northrop Grumman, General Dynamics, all down to the tune of more than 4% today. President Trump pledging to block dividends, stock buybacks, and overcompensation of executives until defense companies speed up production and maintenance of military equipment. The president said execs at these companies should not be allowed to make in excess of $5 million until his concerns are addressed. When I say these companies, he talked about defense companies overall. He didn't name these companies specifically. Go ahead.
Yeah, well, just actually, now that you're saying that, Trump actually out with a Truth Social post right now, this on involving RTX. He refers to it as Raytheon. Of course, this changed its name to RTX. It was lower by 2.5% in the cash session, now down an additional 2% here in the after hours trade. And he specifically calls them out, basically hitting, I'm not going to read this all, but basically hitting on some of these issues with their relationship with the Defense Department or Department of War, as he calls it, and wants them to stop paying dividends.
I'm interested in what exactly prompted this. It sounds like delays of equipment and just how long it takes for this stuff to come. But I would like to hear, what exactly it was that prompted him to send out this post. And
well,
also,
according to him, he says he wants Raytheon. This is a quote.
Yeah.
Step up, start investing in more upfront investment like plants and equipment, or they will no longer be doing business with the Department of War. And if Raytheon wants further business with the United States government, under no circumstances will they be allowed to do additional stock buybacks. This goes on and on. I encourage our viewers to go and check out the full Truth Social post.
Yeah, we should remind everybody, a lot of these contracts are long-term contracts. They're years in the making, and the fulfillment of these contracts are years in the making. Yeah. There are not many companies that can actually do what these specific companies do. So I don't know how much, what the enforcement mechanism would be for certain elements of this. But look, it's a story that we're going to keep following, and it's definitely moving the names of these individual stocks. Also moving lower today, thanks to the president posting on social media. Shares of companies that are in the space of owning homes, institutional investors that own single-family homes. So Invitation Homes spun off from Blackstone years ago. I think it was back in 2017, down 6% today. American Homes for Rent falling 4.3%. Blackstone itself, a major owner of single-family homes, down 5.6%. The president said that he would move to ban institutional investors from buying single-family homes. He said, we'll learn more at Davos. The president said he was, quote, immediately taking steps to ban large institutional investors from buying single-family homes in a push toward promoting housing affordability. So these companies and more fell today. And finally—
Why do I have to wait for Davos?
That's where we're getting more details.
Oh, okay.
More details.
When is Davos?
It's coming up.
It's soon.
Soon, yeah.
2 weeks.
Okay.
Also in the red today, Skyworks Solutions and Qorvo down. Skyworks down 9.7%, Qorvo down 7.5%. Notable laggards in the semiconductor stocks as investors await an update about regulatory paperwork for the planned merger of these two Apple suppliers.
I just want to break in with some breaking news. This coming from AbbVie. Remember, we had a Wall Street Journal report earlier today that AbbVie is in, quote, advanced talks to purchase Revolution Medicines. Now learning AbbVie saying that it's not in talks to acquire the cancer drug maker Revolution Medicines. That is according to a spokesperson. You take a look at the reactions in shares. AbbVie shares down about 1% after hours. Revolution down about 13% after hours. That's after a day in which it gained about nearly 30% in the regular session on this deal speculation. Some of that being reversed right now, Romaine.
Yeah, absolutely. Here, we take a quick look at yields. You did see a lot of activity in the yield space today, but the net effect of it all, at least on the shorter end of the curve, was not a whole lot. You saw a slight uptick on the 2-year yield, a slight downtick on the 5-year and the 10-year yield, but on the longer end of the curve, when we were talking with Kevin Nicholson about this just about an hour ago here, keep an eye on that 30-year yield, down about 5 basis points today to around 4.8202 and change.
All right, guys, some earnings crossing the Bloomberg terminal. Constellation Brands, and we see this stock moving higher in the after hours. The company reported comparable earnings per share for the third quarter that beat the average analyst estimate. So we're talking about $3.06 a share versus an estimate of $2.64. Net sales $2.22 billion. billion. That's down 9.8% from a year ago. The estimate, though, that is above the street estimate of $2.16 billion. And again, you can see that stock up about 3 1/3 in the after hours. All right, guys, that is a wrap. Our cross-platform on radio, TV, YouTube, Bloomberg Originals. That'll do it for us. You guys continuing over there on TV. Katie and Romaine on The Close, and Tim and I right here on Bloomberg Business Week Daily on Bloomberg Radio. We will see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. When we come back, we are going to focus in on the big stories of the day, everything what's going on in the commodity space, and more importantly, into the housing market and into the financial sector. A conversation up ahead with the CEO of Southern Bancorp. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. It looked like we were maybe going to get another day of gains for U.S. equity markets, but a lot of issues coming out of Washington today that cause investors just to pull back just a bit here. 69.20 and change for the S&P 500, down about 0.3% from where it was yesterday. But these next three lines on your screen kind of tell the story of what actually really drove the market. You have oil refiners as a group up about 1.7%, defense stocks as a group down about 3%, and asset managers, which largely includes Blackstone, as a group, Katie Greifeld, down 3% on the day.
Well, that leads nicely to the board behind me. A lot of bad news in terms of stocks. You can see that Lockheed Martin up there declining nearly 5% after President Donald Trump basically took aim at defense companies, saying that, he's going to stop them from issuing dividends, issuing buybacks. Lockheed obviously taking a hit here. Kraft Heinz, this is an interesting one. The U.S. updated its dietary, its nutrition guidelines today, basically de-emphasizing added sugar. That is bad news for Kraft Heinz, down about 2%. And then at the bottom of the screen, Blackstone, down about 5.6%. And that takes us to our top story this hour, which is President Donald Trump pushing to ban institutional investors from buying single-family homes. The president saying on social media, quote, "People live in homes, not corporations." Now, those comments come after Trump last month said that he was planning to unveil, quote, "some of the most aggressive housing reform plans in American history," Romaine.
All right, well, let's bring in someone who knows a lot about this. He's a veteran in the real estate space, Sean Dobson. He's now the CEO of Amherst, a significant owner of single-family rental property. Sean, when you heard about this news or saw the Truth Social post here, what was your main reaction immediately?
Well, good to see you, Romaine. I think my first reaction was, oh no, not this again. This narrative has been floated around out there for a couple of years. It's patently wrong. Banning investors from putting capital into the housing market is not going to make affordability any better. And we spent a fair amount of time in Washington with policymakers, and I thought we had agreement on this up until this morning.
Well, I am curious, and I'm just going to play devil's advocate for a second, Sean. There are a lot of people that look at Blackstone or they look at Amherst and other investors in this space, and they will say that the affordability crisis, meaning the increase that we're seeing in either the price of a home to buy or the rent that you would pay, is being driven more so by investors like yourself rather than just sort of normal organic market functions. How do you respond to that?
It's a fascinating narrative. It just the math is not there. Our market share isn't large enough to move home prices. As you know, mortgage rates went from 3% to 7%, and that made housing unaffordable for a vast cross-section of the U.S. nation. And as you also know, Ray, the government spent trillions and trillions of dollars in response to COVID, well beyond real response to COVID. It became an opportunity to spend on every pet project that people had imagined for the last 30 years. And that devalued the dollar against assets, and it hurt all of us. Incomes went up about 15%. The cost of housing went up about 30%. So this is a government spending created problem, and large investors make for fun scapegoats during election years. But the hard truth is there are real families that might be affected by this. We serve about 200,000 people that live in homes that there's no other way for them to live in unless we own it and operate it as a rental. The facts are that homeownership in this nation is higher than it's been in a very long time. So there's not some big loss to investors in the housing market. And this is a political narrative that is pushed forward for political purposes. It's not going to make any economic impact.
Well, Sean, you mentioned that, you spent time in Washington talking with policymakers. Your understanding was that you were on the same page. Maybe you were up until this morning. But what does the path forward look like? Have you been in touch with anyone from the administration today? Do you have plans to be?
I'm sure we'll speak to them. I spent a fair amount of time with senior people in the administration a few months ago talking about this. And look, I think that politics are weighing in here because the midterm polls don't look very good, and affordability ranks as the number 2 or number 3 issue in priorities across the nation, as it well should be. But we're looping in housing affordability to be a solution for groceries and other issues. So look, our track record is undefeated when we go and sit down with people who actually look at the numbers and look at the service we provide, the people we serve, and really the consequence of not providing mortgages to the average American family any longer. It takes a very high FICO score. It takes a very large down payment, and fewer American customers are served by the American mortgage market. And that should be the real focus, because if people can't get mortgages, it doesn't matter what the house costs. They're not going to be able to buy it.
Well, Sean, you make the point that you take a look at the percents here, and institutional investors really make up a small fraction of who actually owns these single-family homes. But that being said, I mean, the narrative does exist. There is that narrative out there that, you have these big corporations buying up large swaths of American housing supply. And I mean, how do you navigate and run a business sort of in the face of that narrative? Because for better or worse, it exists.
No, it's true. The narrative has power. It has strengths. Even if it's patently incorrect and patently false, it sounds good, and people want someone to blame. The cost of housing is too high relative to incomes, and they need everyone wants someone to blame. And of course, Washington, D.C. doesn't want to go look in the mirror for this blame. They want to go blame someone else. So it is hard to run a business in this environment where there's sort of the religion of short-termism and topic of the day in something that's important as the U.S. housing market. So this will serve to chill capital formation. Investors will have to now think hard about allocating capital to the sector. It was politically unpopular during the Biden years because this narrative was out there. And all it does is it makes it more difficult for platforms like ours to provide more housing opportunity to that cross-section of the population that is not served by the mortgage market. And that's what we do. That's what we're going to continue to do. And this will pass because when I sat down with the most ardent critics of our business and they really understood the financial profile of the customer I serve, someone with a 625 FICO who's living in a $350,000 house for $2,000 a month, they realized there is no better solution than the one we provide.
I am curious, though, Sean, when you look, I mean, one thing about your company, too, I mean, you guys obviously have a lot of data that you're able to collect on the housing market to kind of see where trends are going. When this whole news broke, the first thing we did here at Bloomberg was really try to figure out sort of what the impact of investors like you have on this market. And it was hard to quantify. I mean, the Fed has done some studies, and it seems that the impact is relatively minimal, at least based on the data that they have. Why can't you just sort of, and I mean that in the royal, not just you specifically, but why can't you and your colleagues just kind of put that all in a binder, go down to Washington, show them what the impact is, and lobby them on a solution that actually does address the affordable housing issue?
Well, we did, and you're right. That is the solution, and I'll try harder. I went to school to learn math. I didn't go to school to learn a political narrative, but I clearly should have. But that is exactly what we'll do. And I got to tell you, the answer to what the problem is politically unpopular. The answer is more subprime mortgages. And calling the mortgage crisis the subprime crisis did everyone a disservice. It wasn't a subprime crisis. It was a fraudulent mortgage crisis. And it wasn't because we lent money to people with credit scores below 750. That's not what caused financial crisis. What caused financial crisis were fraudulent mortgage originations made to consumers who were exaggerating their income, by bankers who were exaggerating the value of the loans. So we called that subprime, and that means we shut down lending to American families that have missed a couple of car payments in the last 5 years, who got delinquent on a credit card once in the last 4 or 5 years.
All right, Sean, we have to leave it there. Really great to get some time with you. Appreciate it. That is Sean Dobson. He is the CEO of Amherst. Of course, we're talking about President Trump's earlier Truth Social post, and we have another one.
Yeah, and we're going to get back to the affordable housing issue with the CEO of Southern Bancorp about some of the solutions there. But the president now treating once again, this time a Truth Social post with regards to the military budget, a $1 trillion military budget that he says should go up to $1.5 trillion in the next budget cycle, a 50% increase. A lot of those defense stocks that had plunged in the cash session now up significantly here in the after-hour session. Lockheed up 3.8%, and most of the other names like Northrop and General Dynamics following them higher. We'll be back in a moment. This is Bloomberg. All right, we want to get back to that story regarding the affordability crisis here in the U.S. and a potential solution being proposed by President Trump. Darrin Williams joins us right now. He's the CEO of Southern Bancorp, an Arkansas-based lender with about $5 billion in assets. It's also one of the oldest and largest community development financial institutions. And I bring that up because CDFIs have always been instrumental in helping lower and middle income people actually get mortgages and buy homes. Do you see a role going forward, whatever these policies are going to be out of Washington, for Southern and your peers to do that, help with that?
Well, first of all, Romaine, thanks for having us on. Absolutely, there's a role for CDFIs. 60% of our work must focus on serving low and moderate income communities. At Southern, we really have 3 verticals that we work in. And these are verticals that have been proven to build wealth for families. The very first one is homeownership. And so about 3 years ago, we started our own secondary mortgage business. And we hired a gentleman named Jeremy Davis, who's a fantastic lender and leader. And this year, we put about 500 families in homes who otherwise would not be able to buy a home. These are first-time homeowners. Our average home probably is about $275,000, $280,000. So we're talking about a small home in the southern part of the United States. But I can tell you what he talks about, the biggest deterrent for families is affordability. And it's often the down payment. So we've created a number of down payment assistance programs to assist families access homeownership.
Really interesting point when it comes to the down payment. Certainly, you have to imagine that's one of the biggest purchases any average person will make in their lifetime. But when it comes to the mortgage piece, we've been watching mortgage rates tick down a little bit over the past year or so. When you see mortgage rates come down a little bit as the Fed reduces interest rates, what trends have you seen in terms of how that translates to people applying for mortgages?
Yes, so anytime you see a downward tick in the interest rates, that's helpful in the mortgage business. But it's got to be that long term, the 30-year, right? So right now we've seen the short-term rates come down. You've not seen the curve bend on the long-term rates, and so that's what you really have to see a real, impact in increasing mortgages.
Give me a sense of what the housing market actually looks like in the areas that you operate. I mean, you're primarily down south, Arkansas, Missouri, Mississippi, Oklahoma. I'm probably forgetting a couple other states.
Yep.
What is it like there? Because when we talk about these institutional investors, and every time we ask them where they're buying, it's always the states I just mentioned, the Sun Belt. I mean, that seems to be the core arears.
Yeah. So our markets are pretty diverse. So we're in some very, very small rural markets. But we're also in some larger metro markets. So 75% of our bank branches sit in counties with less than 20,000 people. And so in those markets, it's really about housing stock. People are not moving there to build homes. And so the housing stock is an issue. In some of those more populated communities in Texas, in Little Rock, and in other areas where we have a little more population, you're seeing that average home price tick way up outside of reach affordability for people. And it is a challenge.
And Darrin, we have only about a minute left with you. I want to talk about your recent acquisition of Legacy Bank that just closed this week. That brings your total assets to nearly $5 billion. Why this combination and why now?
Yeah, it's exciting for us. So Legacy Bank and Trust, outstanding group of people. They are also a CDFI. It's the first time we've actually had a CDFI buy a CDFI, for us to buy another bank that's a CDFI.
Oh, wow.
Their team and their tools and our talent combined is going to be powerful. It puts us in 5 states. It gives us an affordable housing practice, a LIHTC business that has completed business deals in 35 states. Combine that with our mortgage company, it's operating in about 8 or 9 states. We think this is a powerful combination really to support LMI communities and families that need the type of bank and brand of banking that we provide.
Well, Darrin, really great to talk to you. Hope to do it again soon. That is Darrin Williams. He is the CEO of Southern Bancorp. Meanwhile, coming up, a conversation with the founder of defense tech company Anduril. Palmer Luckey joins us next on the program live from CES. That conversation up next. This is the close. Well, CES Day 2 is well underway, and with that in mind, let's go to Bloomberg Tech co-hosts Caroline Hyde and Ed Ludlow, who are on the ground in Las Vegas with Palmer Luckey. He is the founder of Anduril. Over to you guys.
Katie, thank you very much indeed. And we are on the floor of CES, but we've got some serious conversations to have, not just about retro technology that is being brought back by Palmer Luckey in one of his startups, but we also want to talk about Anduril, because very much defense tech is in the eye of the storm right now. We have 2 Truth Social posts coming out from the president talking about the publicly traded defense companies shouldn't be doing stock buybacks, shouldn't be paying dividends, and need to focus on investing in America. Where do you think that is being pointed at, and why do you think it's being announced now?
Well, you can probably guess where I fall on this issue. President Trump is saying that he wants to see defense companies building new plants, building new factories, delivering on time, and then maintaining systems cost effectively. And that's, trying to do more of that is why I started Anduril 8 years ago, because I looked at the United States defense industrial base and realized we weren't moving fast enough. We weren't building new plants. We weren't building the new technologies that we needed. And so I'd say I'm broadly aligned. Personally speaking, I think dividends and buybacks are actually very, very different in their tenor. And I think probably I'm much more on the sides of not allowing these companies to do dividends, certainly not when they're years behind on critical programs where they are failing to invest in new things. Stock buybacks are a little different because you're investing in yourself. You're basically saying, I believe that my future is better than my past. That's different than a dividend, which effectively ends up just being a tax on taxpayers to pay for defense straight into the pockets of public market investors. So I look at these things a little differently. Big picture, if these companies were doing really well, and if they were living up to their end of the bargain, I don't think you would see any action from Trump or others on this. It's really a reflection of how many problems we have with our defense industrial base.
These are your competitors, right, Palmer? You
Yes.
compete against them for contracts,
That's
the
right.
same pot of money.
That's right.
And, to be fair, in the time that you and I have been doing interviews, you are typically transparent. One of the provisions that the president proposes is a salary cap of $5 million.
Yep.
In the Bloomberg story, it outlined some of the comp of those CEOs.
That's right.
Would you be willing to say what you pay yourself at Anduril, and if you would abide by
I pay myself $100,000 a year. So
significantly less than a $5 million cap.
True, but I also own a lot of my company.
Correct.
And so this measure is not really written in a way where it's intended to hit new companies, starting new things, act like if Kelly Johnson were alive today and he owned a bunch of Lockheed Martin or Northrop Grumman or Raytheon, I don't think that anyone would have nearly much of a problem with him. But yeah, I pay myself $100,000 a year. That's my compensation package. I own a bunch of Anduril because I started the company. So my motivation is to try and build it the biggest thing possible. I will say, people have fairly critiqued and said, but Palmer, are you really a neutral party here? Are you really in a position to comment, given you're competing with these companies? And I'd say 2 things. One, these measures do apply in equal measure to me. I now cannot pay dividends. I now cannot do stock buybacks if I'm not investing in new plants, if I'm not doing these 2 things. The other thing is, it's always tricky when you want to, I'm in defense because I wanted to help solve these problems, right? It's actually the same thing with like mod retro in the gaming space. Like, oh, of course Palmer would criticize these other game companies. After all, he's in the gaming space. It's like, but I'm in the gaming space because I want to solve these problems. It's kind of this like catch-22. Like if you're outside of it, they'll say, well, why don't you do something about it then? And you do something like, who cares what you're doing? You're just part of the problem. It's always been emotionally difficult for me.
We also have posts that President Trump is thinking, look, more than $1 trillion should be invested in the area of defense.
The budget should grow.
The budget
He's
should
not
grow.
anti-defense or anti-defense company. That's not for sure. That's for sure.
What's interesting is your company is, dare I say it, considering going public.
Yes.
Would your CEO, do you think the CEO that leads the business when it's gone public should be under these sorts of restrictions from an executive order? Do you think that that's going to be an issue?
I think that when you are on the dole and when you're effectively run on the public's wallet, that the public should be able to impose whatever restrictions they want on you. And you're not asking whether it should be, if I am getting paid by taxpayers, they should have the ability to elect people, elect representatives, elect, who will then nominate people who can hold me to account in any way they wish. If they want to say that I only pay myself $5 million until I'm caught up with my schedules, they should be allowed to do that. If they say that I'm not allowed to pay myself $1 until I get caught up, I think they should be allowed to do that. When you are working on taxpayer dime, there is no level of oversight or intervention that I am against conceptually. Now, I think some of these might be bad moves. They might not necessarily help the defense base, but in concept, I think everything should be on the table. And I think it's even good maybe to scare some people sometimes. You don't necessarily go to people and say, this is the way it's going to be forever. You say, this is how it's going to be until you get your act together. Do you remember being a teenager and your parents say, you're grounded until X, Y, and Z. Bring up your grades, solve your problems, and then we will talk about altering the deal. You say, but this deal has so many problems. If it's like this my whole life, if I'm grounded for the rest of my life, that means I'll have no social life. And your parents are not necessarily looking to ground you for life. They're saying, right now, you're grounded. And I think that that's what you're seeing right now. It's not necessarily a lifetime commitment.
Let me jump in here. I want to bring the Bloomberg Television audience the reporting, because these are two Truth Social posts by the president.
That's right.
They're proposals, but what Bloomberg's reporting in the last hour is that he is considering an EO, according to sources, to make this happen. Answer this. Is Anduril on track with the pledges and commitments it's made in Ohio, the projects that it is contractually obliged the military on, not just in this country, but around the world?
There are a handful of things where we are not, but in most cases we are. So like you brought up Ohio, we're building this huge plant, Arsenal 1 in Columbus, Ohio, where we're building autonomous fighter jets and a bunch of other things, building about 6 million square feet there. We're actually ahead of schedule on that. We had a bunch of people from Ohio that we hired, the first round of factory workers. We brought them out to California on our dime, so we're housing them, we're paying them, and we brought them so that we could put them into our existing factory, teach them how Anduril works, indoctrinate them into our way of manufacturing, our way of thinking. And we've actually already finished that training process, and we've already sent them back to Ohio, where they're helping stand up the factory. We're going into production this summer, and we have a new batch of people that have already been sent back. So on Arsenal 1, we are ahead of schedule. We are hitting our commitments. I think that we're building a new plant to build new things, and we're doing it on our own dime. We're spending $900 million of our own money to build this plant.
Where aren't you? You were very transparent. Some places you're not. Are the weapons working as you want them to? Are they performing in the field?
So some of these things I can talk about, some that I can't talk about. But for example, I have a project that is a man-portable counter-UAS system. And it's
or Anduril?
Oh, Anduril. Sorry. I am Anduril in my perspective. Yeah, sorry about that. Anduril has a project building a man-portable counter-UAS system. We really wanted to have that actually fielded right about now, and instead, because of a variety of reasons, look, we're developing basically a thing that goes on a person and it shoots down drones that are trying to attack you. It's turned out to be a more technically challenging problem than we thought. Now, in that case, it's not a failure of, we're not building a factory or we don't want to invest. It's just, it's a harder technical problem than we thought. I suspect that we're going to continue to run into those. If you only build things with no technical risk, you're not trying hard enough. I think Anduril will continue to do things that from time to time will turn out to be harder than we thought. But, I just need to flip more heads than tails.
When we're thinking about where you stand, where US stands versus China, where does it in terms of drone technology? We're in this context of a geopolitical strain that started this year off with Venezuela. We look now to Russia. How do you see China and the Taiwan question?
China has an incredibly strong drone industry. It is largely a result of state intervention. It's largely a result of industrial policy, of supply chain investments that the government has made, and even trade deals that China has made around the world to allow for these drones to freely flow out in other marketplaces. China has the best drone industry in the world. It's not even close. It's definitely a weakness that the United States has. Now, you saw recently this ban on DJI drones.
Yes.
The intention there is to try and fix that. You can fix these things. The U.S. is capable of building drones. It's just we aren't capable of competing with the labor laws, emissions laws, energy prices from coal plants, et cetera, that you see in China. So I'm hoping that this ban on DJI drones results in a strong U.S. drone market popping up to take its place over the next 1, 2, 3 years. Anduril actually is a drone that we were showing off in Japan recently that's made with 100% Japanese parts. Japan is another nation that can build their own drones. They don't need DJI, but it's hard for that to make economic sense when China is allowed to flood the market.
let's pivot and talk about mod retro.
Sure.
For the lay person, no, I'm going to do it. That's why you're here, right? Your background's in virtual reality, and you've basically rebirthed the Game Boy. I don't know if there's some IP issue on that.
So Mod Retro is actually a company I started when I was about 14 years old, combining retro technology and modern technology to build these kind of tributes that bring the best of both worlds. So like we make, for example, something called the Mod Retro Chromatic. Think of it as like the ultimate tribute to the Nintendo Game Boy. It's a Game Boy cartridge compatible console that has an aluminum magnesium shell instead of a plastic window over the screen. It has a lab-grown sapphire crystal window. It's the largest sapphire crystal window of any product ever, way bigger than you would typically see on like a Rolex or something, because I've got to cover an entire screen. We're also building a new console called the Mod Retro M64, which plays Nintendo 64 games. Think of it again as like the ultimate Nintendo 64. What would it look like if the Nintendo 64 were built with money is no object, the ultimate thing? And we've got some other new stuff coming down the pipe as well. But I've been coming to CES for 17 years now. First year I came was 2010. I think I was 16 or 17 years old at the time. I had to use a fake ID to get into the show because you had to be an adult and you had to be industry. So I just had a fake business card and a fake ID, and I pretended to be from a different company. Now I'm coming with a real ID and with a real company, and I'm seeing all my friends from the VR days, all my friends from the retro days, and of course, a lot of defense presence here too.
How big can Mod Retro be?
Mod Retro is never going to be as big as Apple. It's never going to be as...
How big is it currently?
Currently? Look, you've got a couple dozen people building things for people who really, really care about this stuff. I think that there's some things we have coming down the line that are going to be more broadly interesting. For example, we're working on something. I won't get into the details because I'm not supposed to talk about it. It's a TV that works. So, if you've ever bought a smart TV and had problems, imagine a TV that instead it just did what it was supposed to.
You'll never guess who was complaining about his TV today.
Yeah, I was.
Look, there's a lot of things that we're working on that are kind of learning from the lessons of the past and trying to just bring them into the future. Like, what would you rather have, a smart TV or a TV that shows what you plug into it? I think I know what most people would want, but that's a pretty retro idea, unfortunately, now.
I just want a television that works. Luckey, founder of Anduril, founder of Mod Retro, also CTO at Anduril, I would say, frankly, could not have had a more timely conversation given the headlines of the day. Katie, Remain, back to you in New York.
All right, thanks to Ed and Caroline out there at CES. Of course, always colorful Palmer, Luckey, of course, helped to co-found the Oculus AR. And of course, when we talk about AI and sort of the use of that, we should point out the AI was a big driver of financial markets in 2025. It was a big driver of M&A activity. A new report out from Bain and Company shows that 2025 delivered the second highest total deal value ever. That was up about 37%. And some big questions right now as to whether that continues in 2026. Who better to ask than Suzanne Kumar, the lead author of that report and executive vice president of Bain's M&A practice. Great to see you here, Suzanne.
Hi.
We talk about the big rebound in M&A. Now, we should point out some of that was kind of weighted toward the latter half of the year. I think at the start of the year, there's a lot of concerns about what was going on in the world. Are we kind of past that? Is sort of the path for more M&A activity, not just in terms of value, but really the number of deals? Do you see that going up this year?
Yes. This M&A rebound is centered in the role of M&A and strategy. Companies are responding to a fast-changing world. Those are some long-term trends that are going to continue to propel this wave of M&A.
So when we talk about what continues to drive that here, are we going to be talking about sort of, a public company buying a private company? Is it going to be private companies and looking for exit paths? I mean, what sort of sector of that market ends up being the primary driver?
Well, over the past year, the M&A rebound's been widespread. It's broad-based across strategic buyers, financial investors, venture capital. Everyone's come back. The biggest rebound is in strategic companies, and I think that will continue because, again, these are the companies that really need to respond to all of the disruptive forces that we're seeing today. So AI, which you mentioned earlier, as well as post-globalization, the fragmentation of trade and constraints on capital and the flow of people. These are all impacting strategic choices.
And I want to talk a little bit about the size of the deals getting done. We were having this conversation with Ted Smith a little bit over an hour ago, that you take a look at the price tags. You call it a wave of mega deals that we saw in 2025. What drove that? And do you think that we'll see some similar levels in terms, again, of the ticket sizes in 2026?
Yes, these mega deals drove 75% of the increase. So you're right to put a finger on it, although deal volume did go up too for the first time in 5 years. So it's, again, a very healthy and broad-based rebound. Driving these larger deals is the strategic response and a need to pivot. And so companies are looking for scope deals. It's the highest rate of scope deals. Those are deals that are for revenue and capability growth as opposed to scale. So you can see that companies are really using this to respond to the current environment.
Yeah, that's really interesting, that that focus on scope rather than just scale here. And I want to talk a little bit more directly about AI, because one of the points that you make in this report is that AI is increasingly impacting what deals get done and how. It's not necessarily just the theme of the deals that are getting done. It's actually helping them get across the line. Talk us through what you're seeing exactly there.
So there's a few elements to this, as you said. AI is certainly impacting what deals get done in tech. Nearly half of deals in tech had an AI angle in the past year. But it's also impacting what deals get done more broadly speaking. Companies are looking at the impact of AI on the target's businesses, and 1 out of 4 that have done so have walked away from a deal as a result. So they're seeing something in that target's business that shows exposure to the impact of AI and are walking away. On the other hand, 1 in 5 has said they increased valuation as a result. So it's interesting to see some of the discipline that's coming through and how companies are evaluating the impact of AI.
It's been curious. We've talked with a lot of deal makers, particularly in the AI space, and a lot of them are concerned about valuations. I mean, basically, they've gone to kick the tires of some of these companies and just said, great company, but not at that price. I am curious if we're going to see maybe a little bit more leveling out of these valuations, you know, from the height that we saw where everybody was just putting whatever price tag they could on whatever data center or land that would go on that would house that data center.
Right, and I think that's typical for something like this. It's the new technology and the ecosystem is still playing out. Software companies in particular are going to have to think hard about where do they buy versus partner or build for themselves. Beyond that, for most companies, maybe it's not the time to buy AI. Again, you're looking for alternative ways to get exposure.
Where do you think the actual money for the M&A activity will come from? Do you think this is going to be coming off of the balance, meaning cash, available cash on the balance sheet, or are we going to see more of these companies turning to either the equity market or, more importantly, to debt markets to finance these deals?
Well, there's certainly a lot of demand for capital right now, competing pressures. As we highlighted, M&A as a percentage of cash expenditures is at a 10-year low at least. And it shows that companies are really struggling with how do they allocate their capital. CapEx demands are very high for AI as well. And if you're not an AI player, modernizing your own tech stack so that you can take advantage of the benefits of AI.
Is that, I mean, sorry, but when you say the CapEx, is that competing, meaning the CapEx that they would invest in themselves versus the CapEx? Because, I mean, we talk a lot about the, you know, what is the Ouroboros, the idea of these companies all kind of investing in each other. So it is sort of an M&A play to a certain extent.
Yes, yes, that's true. But even more broadly,
Katie uses it all the time.
It's her favorite word. The circular trades, you know, beyond, so the Mag 7 certainly have a disproportionate amount. They have, I think, $500 billion in CapEx last year versus $9 billion for M&A. But beyond that, companies are finding the need to invest in their own modernization of technology.
All right, Suzanne, I have to leave it there. Great report and great insights here as we start off 2026 with a look back at what had been a phenomenal year for M&A in 2025. Suzanne Kumar, Executive Vice President of Bain & Company's M&A practice. Katie?
Meanwhile, we want to switch gears a little bit because pushing protein and cutting sugar, that is the general message from the Trump administration's new nutrition guidelines, featuring an inverted food pyramid with red meat and healthy fats right at the top. Joining us live with more, I'm pleased to say, from the FDA is FDA Commissioner Dr. Marty Makary. Dr. Makary, great to have you with us. So before we get into the specific recommendations, let's talk about the why, because the last time that these guidelines were updated was, I believe, in late 2020, which was during the first Trump administration. So what has changed in the past 5-6 years that led you to this update today?
Well, good to be with you, Katie. There's been a revolution in nutrition science, recognizing that we have been misled with 60 years of dogma that has determined that we need to have a myopic focus on demonizing fat, for example. We now know that's not true. The field of nutrition has matured to recognize now the importance of protein. So today's new nutrition guidance increases the protein recommendation by 50 to 100%. It shouldn't be at a level so you just don't wither away. We want Americans to thrive. You need amino acids, and you don't have protein reserves in your body like you do for glycogen and fatty acids in the liver. And so when you don't get enough protein, you have muscle wasting. Turns out that one of the best predictors of longevity is muscle mass. And so it's no wonder that we're seeing life expectancy come down and more frailty in older people with nourishing people with protein. That's one of the new guidances, along with looking at ultra-processed foods, refined carbohydrates, and the types of grains you got. We don't want people having grains stripped of fiber and chopped up that essentially function as sugar.
Well, you mentioned ultra-processed foods, and that is one of the explicit recommendations here is to cut back on that. But my understanding is that basically the government is still working on a definition of what ultra-processed foods are. So with that in mind, how do you expect that this recommendation will actually get implemented?
Well, I think we all know it when we see it. Ultra-processed foods are the foods with 20 or 50 different ingredients on the back of the package. There are things that should go bad in nature, but they last for months or years on the shelf without refrigeration. So we are at the FDA creating a more formal definition of ultra-processed foods, and that could be used for education. It could be used for front of package labeling. We have put out an RFI, and industry is submitting their ideas. Nobody has a perfect definition, but we want to get one that can be used for mass public education, because 40% of our nation's kids have a chronic disease. America's kids are sick. It turns out that 60 to 70% of the calories kids in America get today are ultra-processed foods. We're calling that out in today's new nutrition guidance, and we're setting the record straight.
Well, with regards to that, and I am curious, as this pyramid gets rolled out, I mean, most of us, of course, as children, remember just how prominent those pyramids were in our school system. Has there already been discussions about how public schools across the nation are going to adapt their menus to these new guidelines?
There are starting today with the new guidance, Romaine, and that's because people are recognizing that they were misled. Remember in school when we were encouraged to drink low-fat milk? Ironically, they took out natural saturated fats that are not bad for kids, and they added sugar. And so we now recognize that it wasn't one single ingredient that caused our chronic disease epidemic, that is saturated healthy fats. It is the ultra-processed food, refined carbohydrates, lack of fiber, and the immense amounts of added sugar. Romaine, you and I were part of the first generation to have massive insulin spikes in our blood system because of the food we ate. We'd never seen that before in human history. It's no wonder that we're dealing with a diabetes and obesity epidemic. These are the root causes of so many other problems in healthcare. So in a sense, this is a healthcare reform dealing with the root cause.
And I just have to ask, I mean, you think about X, essentially, the food pyramid, you talk about it in school, and then you kind of forget it. I think that most American adults don't spend much time thinking about the pyramid when it comes to making nutrition decisions. So just more broadly speaking, how do you increase the relevance of these recommendations?
We want every school district, every house of worship, every family to have a conversation about what's in our new nutrition guidance. That's why it's short. It's less than 10 pages, not like these previous guidances that were over 200 pages. It needs to be understandable. It needs to identify things like coconut oil and olive oil and the importance of healthy nuts and seeds. We have tried hard to make a couple clean messages, and that is we need more protein in the body, and we need to watch out for the ultra-processed foods and the sugars. It turns out that ignoring that has been part of the problem, and so we're putting that back on the radar.
Dr. Makary, I know this is the big topic of the day for you, but I do have to ask you about what's been going on with regards to flu cases here in the United States. We're now seeing our highest level of flu incidents in about 25 years. There have been widespread reports of people not being able to get over-the-counter medications like Tamiflu on the shelves, not being able to get prescription flu shots. What discussions are taking place right now at the FDA about trying to curb the continued outbreak of this flu virus?
Well, look, this appears to be not only a big flu season, but a flu season that's coming earlier in the year. And so this is a problem that I dealt with as a physician. You'd see an influx of patients coming into the hospital. The root cause of some people needing to come to the hospital is they don't have good underlying health. They have underlying insulin resistance and obesity. But in dealing with the issue at hand today, we want people to know about their options. The flu shot is widely available. It's not a great match this year, but this has been going on for a long time.
Why isn't it a great match, Dr. Makary?
Well, because to give you very sort of a technical reason, the influenza virus has two very flimsy polymerases, which allows it to mutate much faster, about 35 times faster than the COVID virus. And so you can have a match early in the season, and then the flu essentially mutates at a point where the vaccine just doesn't work. Now, we are outlining a very clear goal at the FDA that we would like to see a universal flu shot. If it can be shown to be safe and effective, we would like to see these new promising technologies that target the stalk, that is a different part of the influenza virus, or that have immunity, create immunity to multiple different parts of an influenza virus, including parts that have not yet mutated. These are two ideas out there. They are actively on our radar, and we have said very openly ever since I came into office 10 months ago that we would like to see a universal flu shot that could potentially give you decades of lifelong protection.
Did the lack of this synchronicity in that shot and what this influenza virus is, does that have any connection to some of the shortcomings that we've seen with regards to staffing at the U.S. health agencies?
No. First of all, I think it's important for people to know there were no scientific reviewers that were laid off at the FDA, and what we saw was a consolidation of different IT departments and HR staff at the FDA. The FDA is strong and will continue to be strong. We met all of our user fee target dates this year. We have a record number of approvals in CBER last month. And I'm going to be reporting all the metrics at the upcoming JP Morgan conference next week. But no, it's unrelated.
All right, Dr. Makary, we have to leave it there. And of course, we will be out at the JP Morgan conference next week. We'll catch up with you then. FDA Commissioner Dr. Marty Makary wrapping up our coverage of the close here on this Wednesday afternoon. All your political coverage is coming up at the top of the hour.